Hello and welcome to the second part of trading strategies with moving averages. Now I'll focus on the moving average indicator, one of the more widely used and simpler tools to help improve your trading experience. So what is MA? A simple moving average is a measurement of the central tendency. It mitigates the effect of more extreme price divergences on the chart and helps us determine the direction of the price movement. If we choose a moving average set at 20 days, the prices in the last 20 days will be added together and divided by 20. We should select which price to apply these settings: close, open, high, or some other option. We will use close price as it was set by default. The received value is shown on the chart. This will be continuously updated by the platform, and this calculated average will move on the chart in the form of a line. This line will show less volatility than price. A moving average is simple to understand and is widely used by those who trade in the market. It can be used in all time frames, but it is more useful in the longer term. A moving average set for 4 to 5 periods shows high volatility, almost as much as the price itself, in contrast to a 100 periodic moving average. I will add some more MAs on the platform so you can compare them and understand what I'm talking about. I will add MA5 in red and, for example, MA100 in a darker color. Here you can see the difference is obvious. Another type of MA, EMA, that's exponential moving average, gives more weight to recent prices, and in that way it's more precise. Let's go back to the platform and add EMA to see the difference. I added simple and exponential moving average with the same number of periods, so the difference is clearer. We can see here how the exponential MA is closer to the actual price. We can see that the line, as a measurement of central tendency, represents a moving average and oscillates far less compared to Japanese candlesticks, which represent the actual price movement. Using one MA can be useful in defining a trend, while deciding where and when to enter or exit a trade. Using MAs in combination can be much more convenient and effective. Moving averages don't tell us a lot by themselves. Several moving averages placed on a single chart can give you a broader picture. When we want to determine moving averages that we are going to use, i.e. the time interval for which we want to set them, we first need to decide whether to invest on a short or on a longer term time frame. Day traders should use 15 or 30-minute moving averages, or a 4-hour MA at most. 50-day moving averages or higher are not recommended. Don't mix time frames with number of periods. Time frames show how long the one period is, or how long one candle on the graph lasts, while the number of periods included in MA settings is the number of periods taken into consideration while creating the MA. So if you are using a 1-hour time frame with a 50 MA period, that means that MA50 would be created from 50 1-hour candles. There are different combinations of moving averages. However, we should be aware that they are lagging indicators. They give signals only after the price movement has already changed. This lag decreases as we decrease the amount of input values, i.e. the time frame of the moving average. So the trend should be caught as soon as possible. But keep in mind that it's very difficult and rare to enter a position at the very bottom and close it at the very top. But if the trend is strong, it's possible to catch it relatively early. It's also important to determine the moment to enter a position. Take profit levels and stop loss orders should be used in order to control risk. moving averages are recommended for longer term strategies. In this case, we will use the daily time frame. On this chart, we have an example on how to use combinations of moving averages. Here we have 4 lines, 3 moving averages and the actual movement of the price. The green line below is the 200 daily moving average. Obviously, it's the least volatile because it contains a large number of periods. The other red line here is the 50 daily moving average, and the black line is the 20 daily average. The golden cross signal is when the slower, short-term moving average crosses from below a longer-term moving average. In this case, the 20 MA is crossing the 200 MA. Here, the 50 SMA is crossing the 200 SMA from below. In fact, this is a trend confirmation suggested by the previous cross. So, this is a buy signal. We should enter a buy position when the 20 SMA crosses the 200 SMA from below, like here. The goal is to profit as much as possible from the uptrend. The first cross between the actual price and the 50 SMA is a signal for caution. If the 20 daily SMA crosses the 50 SMA from above, it's a strong signal to exit the buy position. The price difference from here to here is decent profit, since we can see that the distance between 1.07 and 1.187 is not insignificant. When the short-term SMA crosses the long-term SMA from above, this is called a dead cross. This is a signal to exit the position. This line can be used to set the stop-loss order if we had entered a buy position somewhere around here. In that case, the stop-loss order would be set at the level of the 200 daily SMA. EMA is used to determine trend changes. The basic principle is, if all MA are moving in the same direction, the trend is strong. The sensitivity of this line or curve is adjusted by setting the amount of periods in use. The shorter the number of periods used for calculating the MA, the more sensitive or volatile the curve is. For example, 4, 8, 12, 16 daily MAs are better for a more decisive determination of trend change compared to longer term ones like 50, 100, 200 MAs. Moving averages with a larger amount of periods are more suitable for long-term trading, while moving averages with a smaller amount of periods are more suitable for short-term traders, with trades staying open for several weeks. It's very important to consider our time scale, whether one is a long-term trader or a short-term trader, and adjust moving averages accordingly. For example, here's a series of exponential MAs for periods from 10-day to 80-day. According to EMA ribbon strategy, when all the moving averages cross, that is the clearest signal to enter a buy position. So here we can see that one by one, moving averages cross over the slower 80-day moving average. Once all of them cross over, it's the clearest signal. However, after the first 3 to 4 MAs cross above, this indicates a potential change of trend. After the last one crosses, it's the clearest signal to enter a buy position. So what happens later? In the moment where one of these MAs start to drop, it's a cause for caution. However, the clearest signal to exit the position is when all of them cross below. The strategy has a lagging effect. For this reason, it shows a trend change with a delay. For this reason, traders use exponential moving averages and combine moving averages with other indicators for additional confirmation, most commonly oscillators, relative strength index, and so on. For indices and major currency pairs, the best combination is RSI with 9 or 16 period moving averages, depending on the timescale. For other currency pairs, particularly those that contain the Japanese yen, stochastics is recommended, with the same moving average. For commodities and shares, CCI, the Commodity Channel Index, should be used in combination with the moving averages. On this chart, we can see how the Relative Strength Index and 9 EMA, the green line, and 16-day SMA, the red line, interact to create a trading signal. If the RSI breaks the line of moving averages from below, it's a buy signal. When the RSI breaks the 9-day moving average from above, it's a signal to close the position. On this chart, we can examine the relationship between the stochastics oscillator and the moving average. So this red line is the moving average, SMA 16. While these two lines, the blue one and the one in dots, are lines of the stochastics oscillator. The trading signal is when the stochastics line and 16-day moving average cross, while the signal to close the trade is when the stochastics lines cross above 80. So here we enter a trade, when the stochastics oscillator crosses the moving average from below. When the oscillator goes into an overbought zone, and the faster moving oscillator line crosses the slower moving one from below, that is the signal to exit the position. And finally, CCI in combination with the moving average. CCI has values from -100 to +100. In the zones above +100 and below -100, we should avoid entering a position, since there is a lot of uncertainty. If the CCI is within the -100 to +100 range and crosses the moving average top down, that is a clear signal for exiting a position. Or in this case, you could enter a sell position and catch as much as possible from this downtrend. While the CCI is below -100, you should not do anything. Wait for CCI to enter within the reference value range here. Where it is above -100 and crosses the moving average from below, then enter a buy position and wait for an exit signal. I hope you found this video about trading strategies useful. Please join us again at 4Trade soon.